Preparing for a portfolio manager at Bank of America interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. How would you describe your investment philosophy as a portfolio manager? My investment philosophy is disciplined, goals-based, and risk-aware. I start with the client's objective, liquidity needs, time horizon, and constraints. Then build diversified portfolios using asset allocation as the main return driver. I prefer evidence-based decisions, not market timing, but I will tilt portfolios when valuations, fundamentals, or macro risks justify it. At Bank of America, I would connect investment choices to the client's broader balance sheet and financial plan. While answering, focus on your repeatable process, risk discipline, time horizon, use of research, and how your philosophy fits Bank of America's client-first, goals-based wealth management culture. Question 2. How do you think about asset allocation versus security selection? Asset allocation sets the risk budget. Security selection tries to improve results within that budget. If a client needs moderate growth with controlled volatility, the mix of equities, fixed income, cash, and alternatives matters more than one stock pick. I set a strategic allocation first, then add tactical views based on valuation, earnings, rates, and spreads. Security selection should support the allocation, not accidentally change the portfolio's intended risk profile. Make sure to cover strategic allocation, tactical tilts, diversification across risk factors, rebalancing discipline, and why asset allocation usually explains more portfolio outcomes than individual security picking. Question 3. Walk me through how you would build a portfolio for a new Bank of America client. I would begin with discovery, not products. I want to understand objectives, spending needs, liabilities, tax status, concentrated positions, risk tolerance, and emotional tolerance for drawdowns. From there, I translate the profile into an investment policy and target allocation. I would use Bank of America research, approved strategies, and open architecture where appropriate, then customize for taxes and restrictions. Finally, I explain trade-offs clearly so the client understands why the portfolio fits. In your answer, talk about discovery, investment policy, risk tolerance, tax position, liquidity needs, constraints, model selection, customization, and communication with advisors or relationship managers. Question 4. What portfolio risk metrics do you monitor, and how do you interpret them? I look at risk through several lenses because one number can mislead. Volatility and beta help describe market sensitivity, while maximum drawdown and downside capture show what the client may experience in stress. Tracking error matters if we are managing against a benchmark. I also review concentration, liquidity, credit duration, and factor exposures. The key is matching measured risk to the client's actual tolerance and required return. Be sure to mention standard deviation, beta, tracking error, downside capture, drawdown, VAR if relevant, and the need to interpret metrics alongside client objectives rather than mechanically. Question 5. How would you position a client portfolio in a higher rate, sticky inflation environment? Higher rates affect both discount rates and income opportunities. I would review duration and fixed income, quality of credit exposure, equity sectors with long-duration cash flows, and cash positions earning attractive yields. If inflation is sticky, I might favor shorter duration, quality companies with pricing power, and real assets selectively. I would avoid wholesale shifts based on headlines. Instead, I would test how rate scenarios affect the client's plan and rebalance deliberately. While answering, focus on macro drivers, Fed policy, yield curve implications, equity duration, credit spreads, cash yields, and how portfolio changes should be measured rather than reactive. Question 6. A client portfolio has underperformed for 2 quarters. How would you diagnose and address it? I would first separate noise from signal. Underperformance needs attribution. Was it asset allocation, security selection, factor exposure, fees, taxes, or an unsuitable benchmark? Then I would compare the result to the original thesis and time horizon. With the client, I would acknowledge the outcome directly, explain the drivers, and show the action plan. Sometimes the right move is rebalancing into weakness. Other times, persistent thesis breakdown means replacing the position. Make sure to cover attribution, benchmark selection, market versus manager effects, client communication, avoiding defensiveness, and deciding whether to rebalance, hold, or replace an investment. Question 7. How would you work with financial advisors and relationship managers in Bank of America's wealth platform? At Bank of America, portfolio management is not isolated from advice. I would work closely with advisors to understand the client's full picture, then translate that into investable actions. The advisor may own the relationship, but I need to make portfolio decisions clear, defensible, and compliant. I would use firm research and CIO guidance as inputs, while still checking suitability, risk, tax impact, and whether the recommendation advances the client's stated goals. In your answer, talk about partnering with financial advisors, aligning investments with planning, explaining recommendations simply, respecting compliance boundaries, and using firm research without losing ownership of judgment. Question 8. What is your process for evaluating an individual equity for inclusion in a portfolio? I start with business quality. How the company makes money, whether returns on capital are sustainable, and what could disrupt the model. Then I compare valuation to growth, margins, free cash flow, and the balance sheet. I want a clear upside case, but I spend equal time on downside and what would make me wrong. Even a strong stock idea needs appropriate sizing and fit within sector, factor, and tax constraints. Be sure to mention business quality, earnings durability, valuation, balance sheet strength, catalysts, downside case, position sizing, and how individual holdings interact with existing portfolio exposures. Question 9. How do you manage the fixed income portion of a client portfolio? Fixed income is not just yield, it is ballast, income, liquidity, and liability matching. I manage duration based on rate risk and the client's horizon, then assess credit exposure by issuer quality and spread compensation. For high-tax clients, municipal bonds may improve after-tax returns. I also watch liquidity, because stressed markets can punish crowded credit trades. The bond allocation should support the plan, not reach for yield in ways that behave like equities. While answering, focus on duration, yield curve positioning, credit quality, spread compensation, liquidity, tax-aware municipal bonds if relevant, and the role of bonds in client portfolios. Question 10. How do you choose the right benchmark for a portfolio? A benchmark should reflect the portfolio's mandate, not simply be a popular index. For a balanced client portfolio, comparing results only to the S&P 500 would be misleading, because the client also owns bonds and cash for stability. I would use a blended benchmark aligned with the target allocation, risk level, and constraints. Good benchmarking improves attribution and accountability. Bad benchmarking encourages taking risks that do not serve the client. Make sure to cover benchmark relevance, asset mix, risk profile, constraints, active versus passive objectives, client reporting, and why the wrong benchmark can create bad incentives. Question 11. When and how would you rebalance a portfolio during volatile markets? Rebalancing is a risk control process. If equities rally and a 60% target becomes 68%, the client may be taking more risk than agreed. I use drift bands, cash flows, and tax-aware trading to bring exposures back without unnecessary turnover. In volatile markets, rebalancing also helps counter emotion, buying assets that have fallen and trimming those that ran. The decision should reflect policy, taxes, and liquidity, not market panic. In your answer, talk about drift bands, tax consequences, transaction costs, liquidity needs, behavioral discipline, and using volatility to restore target risk rather than chase recent performance. Question 12. How would you explain a complex investment strategy to a nervous client? I would start with the client's concern, not the product. For example, if discussing structured notes, I would explain what they are designed to do, what the payoff depends on, and what risks the client is accepting, including liquidity and issuer credit risk. I would use simple scenarios: upside, flat market, and downside. My goal is not to sell complexity, it is to make sure the client can repeat the rationale and risks clearly. Be sure to mention plain language communication, linking strategy to goals, acknowledging uncertainty, avoiding jargon, showing scenarios, and checking understanding before asking the client to act. Question 13. How do you decide between active and passive strategies in a client portfolio? I see active and passive as tools, not ideologies. In highly efficient large-cap markets, low-cost passive exposure often makes sense as a core holding. Active management can be more compelling in less efficient areas, such as small-cap, credit, munis, or alternatives, where research and risk control may add value. I would evaluate net of fee, after-tax performance, and consistency versus the mandate. The right blend depends on client goals and evidence. While answering, focus on market efficiency, fees, tax impact, manager skill, asset class differences, client preferences, and combining passive core exposure with active satellites where justified. Question 14. A client wants to move entirely to cash after a market sell-off. What would you do? I would first acknowledge the fear, because a sell-off feels personal when it affects wealth. Then I would revisit the plan, required liquidity, time horizon, and whether anything has changed in the client's life. Going fully to cash creates a second decision, when to get back in, which is very difficult. I might raise near-term liquidity or reduce excessive risk, but I would anchor the discussion in scenarios, not panic. Make sure to cover empathy, behavioral finance, time horizon, opportunity cost of missing recoveries, liquidity segmentation, stress testing, and creating an action plan instead of arguing. Question 15. Why do you want to be a portfolio manager at Bank of America? Bank of America appeals to me because the platform combines Merrill's advisor network, deep research, banking capabilities, and institutional risk discipline. As a portfolio manager, I want to work where investment decisions are connected to a client's full financial life, not made in a silo. I also like the expectation of clear communication and prudent governance. The role fits me because it blends markets, portfolio construction, client impact, and accountability for outcomes. In your answer, talk about Bank of America's scale, Merrill heritage, research platform, client-centered culture, risk management expectations, and the specific portfolio responsibilities that attract you. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.